All right, so in this video, I'm going to talk about terminal cash flows for a capital budgeting project. Terminal cash flows are the additional cash flows that arise at the end of the project's life due to the fact that it is terminated and over and done. So generally, you're going to have a few different things that are going to occur here. Sometimes the purchase of a machine may have triggered some sort of change in net working capital initially, so often at time zero. And it's not uncommon, therefore, that it's assumed that when the project is over, that there is a subsequent change in net working capital again. So as a reminder, if there is an increase in net working capital, then that would be considered an outflow, and a decrease in net working capital would be an inflow. So something to kind of be watching for there is basically, is there a change in net working capital that happens, maybe initially when the project is started, and is there another subsequent change when the project is terminated, the machine is no longer worth anything anymore? Then you also have to look at what happens in terms of the salvage value. So if the terminated project is, the machine is worthless, or perhaps it's not useful anymore for the company and they're selling it off for salvage, how much are they selling it for? So if they're going to sell it for salvage, then it becomes a question of, all right, so we're selling it for that. But then think back to accounting. If I sell a piece of equipment, I have to compare what I sold it for to the value on the books. So I now need to calculate the accounting book value. So accounting book value is going to be the original cost or depreciable basis less whatever depreciation has been taken on that asset during the asset's life. Whatever's left over is the book value in the accounting sense. So I'm going to look at that book value, and then I'm going to compare whatever my salvage value is to whatever the book value is to figure out if there's a gain or a loss on the sale. If there's a gain, so let's suppose that the equipment is being sold for $10,000. That's the salvage value. Let's suppose the accounting book value is $7,000. So it's going to be sold for $3,000 more than the book value. That's a gain. And if that's a gain, then that is going to be taxable. And so we're going to calculate taxes on the gain. And so there would be a tax impact or a cash outflow associated with paying taxes on the gain. And the cash flow from the sale of the fixed asset would then be the $10,000 that the asset was sold for, less whatever the taxes were on that $3,000 gain in this example. On the other hand, what if the salvage value is $10,000, but the book value is 15? So if the salvage value is 10, but the book value is 15, well, we're now selling this thing at a loss. So if I'm selling it at a loss, we're going to generally assume that we have a positive set of cash flow somewhere else in the business. And so if we do, and I have this loss, then basically what will happen is that loss will then reduce my taxable income somewhere else in the business, which means I was about to send the government some more money in taxes somewhere else for some other part of the business, but now I don't have to send as much in taxes. And so if a penny saved is a penny earned, then what that's going to mean is that in effect, I've saved money on taxes due to this loss. And so I would show a positive tax impact here. But again, my cash flow from the sale will be salvage, but then also a positive tax impact because of that loss on the sale. As a side note that's related to this, it's possible for a capital budgeting project to have an operating loss in a given year. And if it has an operating loss in a given year, then it's possible, or at least a pre-tax operating loss on a given year, it's possible to show a positive tax impact on those annual operating cash flows as well for the same reason. And so that is a possible outcome. So you have to pay attention to that. And ultimately, it's the same principle. We're assuming that the company is making money somewhere else in the business. Now, if the company was not making money somewhere else in the business, that might be a little bit of a different discussion. But we're assuming that the business is making money somewhere else in the business. And so if I have a loss that pops up somewhere, a taxable loss, then it actually is going to save me money on taxes. And a penny saved is a penny earned. So you have to pay attention to that. Okay, hopefully this video has been helpful. Thank you so much for watching, and have a great day.